Welcome to another special edition of the 3 and 10 podcast. These discussions with investment or industry leaders are set apart from our regular Friday podcasts. They are both longer and more in depth. We hope you will enjoy, learn, and profit from this special edition of the 3 and 10 podcast. Welcome, everybody, to a special edition of the 3 and 10 podcast. Today, we have an excellent and really timely guest in Drew McKnight of Fortress. Drew is the co-CEO of Fortress, where he's worked for over 20 years. Fortress is a global alternative asset manager focused on credit, and the markets are focused on credit. Fortress navigates across all aspects of credit, from direct lending to distressed and everything in between. So welcome, Drew. Welcome to the audience. And I'll just ask you first off, Drew, tell us a little bit about yourself, where you grew up, how you got in the business, and why you chose to work in credit.
Thanks, Scott. Thanks for having me. Excited to do this. Like you said, I think there's a lot to talk about, and hopefully we can fit it all in. I grew up in Virginia Beach, Virginia. Went to the University of Virginia. I graduated in 2000. So as we were going through the recruiting process onto investment banks, it was in the dot-com boom. And I think we got 2 raises before we even got to our desks in the summer of 2000 because it was the bubble was still inflating. But by the time we got through training, analyst training in the summer of 2000, and by the time we actually started in our groups in the fall of 2000, obviously the talk of a correction changed to, okay, the world's changed. And so it's actually somewhat, these times are a little bit interesting, a reminder. And so that was really right place, right time, where I was originally working in leveraged finance, capital markets, and sales. But again, by the fall of 2000, we weren't really doing any capital markets or selling of originations. And the distress group needed help in terms of learning how to analyze co-location facilities and CLECs and fiber in the ground and, Pacific Crossing, Global Crossing, all these businesses that were really the future of the internet. But the infrastructure was built and the revenues didn't quite materialize. And again, right place, right time, where I was able to just drink out of a fire hose, learn a ton, got to work with a lot of great investors at Goldman, and also as I moved to the distressed trading desk with some of our clients who were working on this space. That transition from the telecom bust and boom to also Enron and all the related energy distress. And so from there, I was really hooked, and I loved it. I ended up going to another hedge fund, Tree Partners, where it also became super steep learning curve. At Goldman was amazing, but we were really focused on, I was on the distressed bank debt desk. And so that was really what we focused on. And at Tree, it was really more of an absolute value shop. So it was 2002. So it was still a lot of stuff to do within the distressed credit space, but we were also investing across capital structures, convertible ARB, equity and options derivatives. And then I moved over to Fortress. Pete Brigger had moved to Fortress in 2002, and I joined him at the end of 2004.
Well, it's interesting. You've got 26 years in the industry, and you started during the tech bust of 2000. So you have that perspective. Do you see any parallels with what's going on in AI and the enormous capital spending today? Is that does some of those things worry you, and you see some shadows of the late 90s?
Yeah, look, I don't want to pretend to say we think there's an AI bubble because we're very, very, very strong believers in AI. But I also think there were a lot of folks in the late 90s that were very strong believers in the internet and in wireless communications. And they were 100% right, but the infrastructure bubble that it took to finance those businesses, some of the infrastructure that the costs didn't match up with the revenues perfectly. And so I would say we are definitely mindful of that and somewhat cautious. And I think there are some real parallels, because I think the breadth of capital needs is immense. I think some of the returns on these are harder to pencil out. And again, we are very big believers in AI, spending a ton of time on it internally, both with our processes, investments, but also infrastructure. But we are cautious on some of the capital returns in the projects. And so we've spent more time in our most recent opportunities funds, which actually, Scott, your investors are invested alongside of us. Two of the biggest investments in that fund, we bought a series of gas turbines a couple years ago. So those are mobile gas turbines. So we're able to put those behind the grid, and those have been a big beneficiary of, I would sort of call picks and shovels around the AI needs, and that's, knock on wood, gone very well. And then we also invested in a company called Boyd Corporation, which is an engineering business around the heating and cooling in data centers, and that was an investment that we made in the summer of 24, and the company sold one of their divisions. We attached about $2 billion enterprise value, and the company sold the whole one of their divisions for $9 billion, and so we're actually going to get paid off on that this month. So we're excited also because I do think the disruption in software for the first time really brings opportunity. I think particularly in the context of private credit and private lending, we've been saying it for a while. It's really hard to know if someone's doing well in a 0% default environment. Because you really don't know if they're doing a good job underwriting. And so we think this volatility and really some potential both economic volatility, but also specifically in the software space, some disruption. We do think you're going to see some winners and losers. And from our perspective, that's really a good way to be able to differentiate.
Well, I sit here in Austin and I read the press and watch the news, and I've been kind of blown away by the bearishness in the press toward the credit asset class. We have historically tight public credit spreads. We have a pretty robust U.S. economy by almost all metrics, yet so many people are looking for trouble in private credit. It doesn't seem to me in some ways to make sense. This is not typically the kind of backdrop where you would have distress in credit. Why do you think the narrative has become so negative toward private credit? And what are your thoughts on that? Is that misplaced, or is it just an unusual environment?
Look, it's a great question, and it's definitely a topical question. One thing that we point out is private credit is something that a name people have come up with. Private credit is just credit, right? And there's different types of credit, but we don't really view public credit, private credit. At the end of the day, it's a bank loan. Sometimes banks hold those loans. Sometimes CLOs hold those loans. Sometimes BDCs hold those loans. And so we don't see that much of a difference. I think some folks point to the growth in private credit and they want to say there's a bubble. Look, the growth in private credit, a lot of that growth has come, and I'm talking really back to 2012, 2013, when a different asset class started to be syndicated. It's grown at a time when banks' balance sheets have been shrinking. It started post GFC with regulatory changes where investment banks really no longer could hold loans. But even commercial banks, if you look at the crisis we saw in 2023 with Silicon Valley Bank, Signature Bank, First Republic, where there was a deposit flight, I think commercial banks and regional banks generally saw, okay, maybe we can't hold quite as much in loans as we thought we could. And so I think their willingness to hold both real estate loans and C&I loans is lower. And so that some of the growth in private credit has frankly been very healthy to fill the void created by some of those initially investment banks and then commercial banks. I do think the growth and the number of players in that space, probably the barriers to entry got a little too low. And I think at the end of the day, to grow in private credit, it's not that hard. At the end of the day, you're offering a loan to someone at a lower rate. So it's very easy to become popular with all the sponsors very quickly. And I think some folks that have grown, particularly folks that have grown really rapidly in that time period, you just have to question what their what their underwriting standards were, how were they thinking about it. We've grown, but we've tried to be very measured, and we've really tried to focus on our growth around what's the opportunity set and size our funds based on what the opportunity set is versus how much money can we raise, and then let's go figure out how to put it to work.
Yeah, good answer. So I want to ask you, when I was diligencing Fortress, I saw lots of areas of differentiation, but I'll just toss it to you. What differentiates Fortress from your competitors? Why and how do you have such consistently low loan losses and high recovery rates? That was something that stood out to me about your firm. How do you do that?
Look, I think it's every bit of the credit granting process, and I think Pete Brigger, who's the founder of Fortress and still the chairman and on our investment committee, Pete likes to credit his mom. She was a credit officer at Chemical Bank in New York City, and Pete says she was referred to as the Dragon Lady. I would never call her that, but Pete says she was called the Dragon Lady of Credit. So Pete claims it's actually in his DNA. But I think from that process, it's both on the way in, really having a very high bar, and I think I think Pete viewed himself as the CIO, and I think now our CIOs view ourselves as the goalies, right? Our job is to make sure if it's going to get on the books, we really know, and we, from a credit perspective, we'd rather say no to a marginal deal than say yes to a marginal deal, because credit's different than equities. In credit, your losers can really blow up the fund. In equities, your winners pay for your losers, and so maybe you're a little bit more incentivized to swing at pitches. And in credit, we really think it's the opposite. But then probably what's more differentiated is our asset management process. We refer, again, Pete referred to that as the periodicity of touching your assets, and particularly on private assets where you're not getting marked to market. You really need to look at what's going on in the credit and have a process to look at it every single month. And so our asset management process is something that we emphasize. I think if you look at our team, we've got more employees per dollars of AUM than literally anyone that I'm aware of in the world of credit. And what that means is we have the resources to touch those assets. Now, in low default environments, there's a lot of redundancies, and we probably have too many folks. But at times like this, it allows us to really, identify problems as early as possible, but then B, throw the resources at them to make sure we're maximizing returns and recoveries.
And Drew, you call this an asset management group, and I would call it a forensic accounting group. Or so. When you revealed this at the annual meeting, I was blown away by the number of people you have on this and the processes that they go through to structure and document everything in a loan.
Yeah. Look, we say it's not rocket science. It's really blocking and tackling and touching and touching those assets and knowing what's going on, and having the resources to do it. Because again, if you look at the growth in private credit and you look at some of the firms that have grown very quickly, you're talking about firms that have 15 or 20 people on their entire investment team, both origination, underwriting, and asset management. And in low default environments, you can do that because you're originating, 5 or 6 loans a month. And once the loan's on the books, you're getting paid as agreed. And so from a monitoring perspective, when things are going well, it's not that much you have to do. The problem is once you go through a little bit of restructuring or a little bit of triage, it just starts to become much more of a time sink. And I think it really, the lack of bodies and the lack of infrastructure, I think will cause some problems for folks if we go through an extended sort of wave of disruption. And that's the other thing that I think, we don't think anyone can say they know what's going to happen in software or AI, but we don't think it's going to be over quickly. The disruption might happen more quickly than we think, and there may be industries that we didn't expect to get disrupted. But we think for the foreseeable future, you're going to really need to this is going to be laser focused and top of mind, all the time. And I think what's exciting to us also is that some of the more marginal players in credit that have been growing more rapidly were the ones that did have maybe more redemption risk. And as some of those investors start to deal with redemptions, they go from being they go from being the marginal price of credit, the marginal buyer of credit, to actually the marginal seller of credit. And so we are optimistic that the pricing environment, we've already seen it even in the first couple months of the year. Particularly on the private side, there's just a little more pricing flexibility. Again, it's fully functioning. We think it's actually a great opportunity set for new underwrites, but it's a little more balanced versus last year where it was definitely a seller's market.
Well, you mentioned software, so I've got to ask about that because it's so topical right now. What is your view on private lending to the software sector? And I'll also throw in insurance brokerage and business services and things that are perhaps more readily disintermediated by artificial intelligence. How exposed is Fortress to software? And I think you might have a graphic for us to show.
Yeah, let me try to pull this up. Look at the universe of both private and public leveraged finance. Technology and software has been the largest sector of issuance, I think, going back maybe as far as 2019. Does that work?
That's it. You
Perfect.
got it.
So if you look at the leveraged finance space, software and technology has been the largest sector of issuance going back to 2019. For us, it's a space where we've had exposure. It was our largest sector of exposure going back to 2019. We obviously weren't focused on AI disruption going back that far, but we did see capital structures get more and more aggressive gradually. And Scott, we talked about both the asset management, but also the process on the way in. And as we saw these loans get more aggressive, the buyouts get more aggressive, the multiples creep up, the leverage creep up. We just felt like your margin of safety was going down. And so while this wasn't some big top-down tactical, we need to get our exposure down, I do think it's instructive. And I think this sort of graph going from 22% down to 8.6% in 25, and then in fact our most recent lending fund vintage 4 is 6.3%. It's just not a material exposure for us. Look, we're spending a lot of time on it today from a new opportunity perspective, but I think this is instructive of just how we manage our risk and how we try to from a bottoms up credit perspective, really price it the right way.
Well, you were ahead of the curve on reducing that exposure for sure. And I also have to say, I haven't read the name Fortress associated with any of the big frauds or anything like that. No Tricolor or First Brands or New Horizons or MFS. None of those. You guys managed to avoid all of them.
Knock on wood. We saw First Brands, Tricolor. We saw a number of them. But there were a few different warning flags that kept us away. A chunk of those were, again, people like to talk about private credit, but a number of those were really the syndicated loan market and even commercial banks. And so which I think speaks to kind of private credit is credit. I also look, we're not saying we're never going to have defaults. We absolutely have defaults. I think we like to say because we've granted over $100 billion of loans going back to 2002. We've lost money almost every way possible, and so we just try to learn from it. But we do feel like the credit process is going to play out, and I think there's some great players out there that I think you'll see differentiate themselves, and there's some folks that were probably more aggressive that will probably have a harder time navigating these markets. But I also think, because I know people like to talk about credit and like to tell the bear story of it. I do think when the dust settles, and again, I think you are going to probably have some defaults and probably have some restructurings, and you're going to have some different losses on different loans. I do think credit's going to hold up very well because I think particularly versus private equity and potentially venture, just because if you think about private credit, right, and these funds. When private credits say we're going to earn you 9 to 11% net, they're generally sending you 9 to 11% or more every single year, and so you're getting some payoffs every single year. And so you're de-risking along the way. And I think, DPI, which is obviously something that folks have been talking about a lot, particularly on the private equity side. If I can earn 10 to 11% on current, as compared to a private equity fund, which on a sheet of paper has told me I'm earning 15 or 17% or 20%, but I get like a 0.1, 0.2, 0.3 times DPI 6 years out. That sort of back end residual in private equity, I think, has a lot of tail risk versus private credit, where you realize even if you have a few, odds and ends to clean up at the end, the portfolio is just de-risked so much. And so I personally think credit's going to hold up very well as like the 2 years from now, 3 years from now, 5 years from now of where, what performed well and what didn't. I personally think credit does have a place in folks' capital in folks' capital allocation models.
Yeah, for sure. I'm reminded by the quote from the great Michael Milken, who said that if you can earn equity-like returns, 9 to 11% in credit by taking a fraction of the equity risk, you got to do that trade.
Right. And if people are worried about really private credit from a market perspective, then they really better be worried about private equity and public equities, frankly. Because,
precisely. The long-term returns on public equity are just under 8%.
Right.
So, and you're taking a lot more risk in public equity than you are in credit by definition, because credit's higher in the cap structure. I think a lot of people misunderstand that. Drew, I want to talk to you about forward flows or asset-based lending. What are forward flows? Is Fortress still very active in this segment of the private credit market, and why? What is the opportunity you see there?
Sure. So forward flows, they really encompass a broad range of asset-based credit, a lot of consumer credit, some real estate mortgage, residential mortgage credit, but generally consumer-based credit. We've been active in the business. We had Dom Ruggieri, who runs the business for us, has been at Fortress since 2007. So we've been active in the space going back nearly 20 years. We did see a pickup in the pace of deployment going back to 2023 and 2024, which is really on the, I mentioned the Silicon Valley Signature Bank. Those firms specifically didn't have necessarily exposure, but I think the deposit flight, the fractional reserve, the stress the fractional reserve banking system felt caused banks to pull back from that market. And so some of the origination platforms like SoFi, who had historically had big origination platforms, they were generally selling their origination onto financial institutions, small and regional banks, community banks. They saw those banks pull back, and their origination businesses were looking for partners. And so we were able to step in with highly structured criteria in terms of eligibility criteria. So we could go work with SoFi to say, hey, here's the FICO scores we need. Here's the criteria. Here's the credit protection we want, meaning if there are defaults, we want SoFi, the originator, to have to kick in more cash. So there's a lot of different ways we can do that. And there were wins for SoFi because SoFi is an origination platform where them knowing they had a reliable counterparty to take their origination allowed them to grow their business. And so that's been a business that we've grown pretty attractively over the past 2 years. I would say the pace of that growth had slowed down in 25. It remains steady, but it remains steady probably with our existing relationships as opposed to phone ringing off the hook where there's new originators out there. Going back to the asset management, I do think having the infrastructure to monitor those portfolios is incredibly important. Dom's partner, Dwayne Chin's been here back since 2002 and has a team of nearly 20 people on the asset management side, making sure you're monitoring those portfolios. And so I think we see the consumer as somewhat, there's parts of the market that worry us, auto ABS. I think you've seen some warning signs on subprime side, but we see the consumer fairly attractive. We've obviously this year you've got some tax cuts that kick in and some refunds that'll kick in that probably give a little bit of relief to the lower end consumer. But you're also focused on the AI disruption and when you start to see those, job issues. Again, our perspective on AI is probably some of the first cuts might be more white collar than blue collar, but it's definitely, I would say, top of mind.
Well, Drew, as we sit here today in this part of the cycle where we do see some rumblings and some signs, how is Fortress positioned across the different funds are you positioned to take advantage of rising defaults? And not to say that you would cheer for that, but would that present a really good opportunity for you with dry powder set aside to take advantage?
Yeah, generally our best vintage and our best years are when there's a little more disruption and when there is a little more volatility. I think what we say is we want to be able to, on the credit side, perform with our peers in benign environments, but really outperform in the more volatile environments. And for credit, if you really look at that over the fullness of a cycle, it really meaningfully improves returns. Again, I would say you said it right. We're not cheering for any of that, but we are, we believe it's almost irrefutable that it's going to be coming. And so it's making sure we're monitoring, number one, monitoring our existing portfolios, but then also, sourcing new opportunities. And I would say within both our credit ops fund and within, Drawbridge Special Opportunities, which is our multi-strat opportunistic credit fund, we are, I wouldn't say we're very active investing right this second in the public markets, but we've got watch lists and we're monitoring as these play out. And we do think this opportunity set plan, that's leading in not just for this year, but really probably for the next couple years, because you've got this, the combination of maturity walls, you've got private equity funds that are under pressure for realizations, and you've got the AI disruption.
I think, all of a sudden the world feels like kind of a dangerous place with the Iran war, the Fed in transition. We're not really sure when Warsh is going to come in because of political dynamics. So Fed's in transition. We've got fairly persistent inflation. We've got oil prices rising dramatically in this week. So that's potentially a tailwind for inflation. We have AI CapEx booming, maybe too much booming, and we've got disruption from AI. So how is Fortress approaching this suddenly dicey investment backdrop?
Look, I think it's the same way we've done it from the beginning, where we really go asset by asset, bottoms up. And so our investment committee process, whether we're looking at an asset-based credit loan or forward flow, or buying gas turbines, or publicly traded, distressed credit, it's really about, how are we getting our money back, right? How are we, again, whether it's a 20% opportunity or an 8% opportunity, it's how do we know we're going to get our principal back? What's our path? And I think, again, across different strategies, across different funds, generally, if I would say there's a hallmark, it's generally, even if things go wrong, you have a path to getting your money back. Again, not every single time, but our loss, our severities given defaults is generally pretty low. And so that's probably number one. And then number two, it's really making sure we're open-minded around what can happen, and open-minded around the different asset classes. And right now, these are one of those times where having the breadth of our team is a big competitive advantage, because we can talk about what's going on in asset-based credit and how that risk is priced and what the returns are in different scenarios. We can talk about what's going on in the software space. Within our lending business, oil and gas has been one of the larger exposures we've had over the past, call it 2 or 3 years. Again, it wasn't a top-down call to say, hey, let's shift from tech to oil and gas, but we saw more folks competing to do tech investing. The capital structures got more aggressive. The attachment points got more aggressive. We saw at the same time in the energy space, where the RBLs and a lot of the commercial banks were pulling back from doing that, for a whole host of reasons, some of which were non-economic. And we were able to go and provide loans to businesses at, PDP 15, really, really conservative attachment points, and get paid, a couple hundred basis points north of where a similar sort of rated software credit would trade. So we don't have the slide, but I'm sure we could get it. I think if you probably graphed our energy exposure from 2019 till 2025, it would probably look the opposite of that tech exposure. But that's like when I started, it's really a bottoms up. Where are the opportunities? Where's the risk? And where is the risk most attractively priced? And so,
interesting. You ended up getting the macro right by starting from the bottom up. I love that.
Right. That's right. And then look, Scott, you and I have talked a little bit about some of the macro right now, which again, I don't remember a time that had as much swirling between tariffs, between, geopolitics, and then factor in Iran. And, I think we all hope and pray that it's over as quickly as possible for everyone. And I think there are paths to see that. I also think there's some paths that make it harder. And so you just hope that I think we're going to have to be dealing with it, and it's going to be very difficult as we go through.
Well, I think we'll segue just for a few moments away from credit and Fortress, and I'd just like to ask you a few quick lightning round personal questions. In your career, Drew, who is your most important mentor, and what did he or she teach you?
Yeah. Hopefully it doesn't seem cliche, but I joined Fortress when I was 26 years old. And until I moved to Dallas, I either sat next to Pete Brigger or behind Pete, back to back with Pete Brigger the entire 20 years. And so, Pete, first and foremost, and we overlapped to Goldman before that as well. And so he's kind of head and shoulders, both the way he built the business, the way he invests, the way he leads people. I always said from the very beginning, again, I was 26 years old and, learning the business, but also learning what it means to be a leader. And I always said Pete was the guy that was the general at the front of the army with blood on his uniform, ready to lead. And he was never a guy in an ivory tower, never asked anyone to work harder than he was working. So for me, that was something that I always identified with and try to emulate for sure. And then number two is a guy named Andrew Fredman, who was one of the partners at Furtree. Unfortunately passed away a few years ago, but he was a great mentor, a great teacher, loved to teach, had just an insane passion for investing. And so Andrew was also was amazing. Yeah,
great reputation, both of those guys. Just curious what you're reading these days in the age of AI.
This is actually true, and it's not because he was your last or one of your last podcast guests, but I'm actually reading The Peacekeeper, which is Will Imboden's biography on Ronald Reagan. It came out, I think, either last year or maybe the year before. I remember Reagan, but I remember some of the good things, but I wasn't living in the moment of exactly what he was doing from a policy perspective. And Will wrote a book really from the beginning of his presidency, his candidacy through his 2 terms. Right now I'm actually on the chapter called Waiting for Gorbachev, because Reagan was so focused on how he could find a way to make peace with the USSR and peace through strength. But he did deal with having 3 leaders of the USSR before Gorbachev, some of whom didn't want to meet with him and some of whom just weren't in the seat very long. And so I think that transition was difficult. It probably also allowed Reagan in the U.S. to get an upper hand as he had consistent policy through that period to position him when he ultimately got Gorbachev. But I haven't got to that part of the book, so I'm looking forward to it.
It's a good book, and Will Imboden has so much wisdom. He's really a polymath. He's done so many interesting things: author, educator, starter of businesses. And I guess my last question to you is, what do you like to do outside of work? What do you have time to do outside of running Fortress?
Yeah, I have my wife, Amy. We've been married for almost 22 years. We met 4 months out of college for me. And so we've been together a long time. And so I like spending time with her. And then I've got 2 kids. My daughter, Bo, is 18 and about to go off to college. And my son, 16, is a sophomore. And so I would say right now, particularly in the context of seeing a daughter, not just a few months away from leaving the house, try to spend time with them. They obviously have their own lives and are independent, and they spending time with me isn't quite as important for them as it is for me, but savoring those times. And I do play a little bit of golf. Luckily my son plays golf now, so that's probably the best thing for my golf game is I actually get to spend, 4 hours with him when we get out there, and that's a special time for me.
Drew, that's great. I can totally understand. My daughter is coming home from boarding school tonight, and I can't wait to spend time with her. So, well, thanks for these great insights. It's really good timing. Thanks for joining us, and thank you and Fortress for being such valued friends and partners to Capitol Creek.
No, you guys are great, and we look forward to these next couple months, these next couple years. I think could be a lot of fun.
You got it, and thanks to our audience for joining in and listening to us today.
All right, thank you, Scott.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.